Welcome, everyone. My name is Brendan McCarty, Chief Investment Officer of Column E Advisors, and welcome to our first three charts in time, the video version. We had previously posted a three charts in time to our blog, more of a post form. Today, we're going to feature the video. In addition, we will post the three select slides as in the on the webpage as well, so that you have this as an accompaniment to the video or for later review. In this presentation, we will discuss the basic theme of lost energy in the equity markets. This sort of ties to our 2021 outlook, where there were two major risks to equity returns, as well as asset returns. First, an inflation spike. We thought inflation could go two ways in 2021. We favored the 1970s version, thinking the Fed would just pump in more cash, forcing up assets, have demand rise further, and prices skyrocket. We have seen that in the commodity sphere, and now we're seeing that pass through into the consumer prices. All you have to do is walk down a grocery aisle and see that as of late. The second threat was a drop in equity risk premium, or the risk taking in stocks. This happened. We were drawing two similarities in the past to 2005 and 2010. In both cases, equity risk fell. In 2005, returns were flat for the year as equity risk continued to fall even as earnings climbed. In 2010, we saw a very volatile summer fall that was led by that May flash crash. That volatility remained until mid-July, and then markets resumed to climb into year-end as earnings ultimately won out, but the PE of the market moderated still further. We're seeing perhaps the beginning of that trend now, and let's discuss these three charts to explore that. And our first chart, this is our equity risk trading model. Basically measures the amount of risk being taken in buying stocks or in the current stock market. As you can see, there are two major pieces on this chart. Far left, you see the lows of early 2009 to the highs of early 2010. In this one, you see it from mid-March 2020 to May 10th of this year, where it peaked. The one key similarity here is the rise. It's very similar in terms of the climb, in terms of the slope. The difference between the two is the base. In 2009, nobody wanted to own a stock. In 2020, people didn't own stocks for a total of about 3 weeks. That means that all the energy that came into the market entering 2020 was not extinguished like it was in 08, 09. As a result, we came off those lows at an increasing rate. Combine that with about $5 trillion of Fed money and add in stimulus checks, and what you have is the S&P at 4,200 and change, give or take, as last tick. As you can see from the model, and comparable to 2010, when it rolls over, what we see is a rise in volatility and a slow in the momentum rise of the stock market. We're seeing that now. Over the last few weeks, equities had a rough week last week, followed by a very weak rally, and we'll explain that in a second. But the ERT has turned lower for the first time in nearly 14 months. When an indicator runs this long and finally goes in a different direction, it comes down to what follows is two things: a significant correction, or a very long basing. Third option of a rally is not really a high likelihood event at this point, though we are watching 4,100 as a key pivot in the S&P 500. As long as we remain above it, the bulls can be happy. If we fall below it, the bulls might want to worry a bit. The second chart is our market breadth model, which ties in to this loss of energy in the markets. You can see in late February, it peaked up near 60%, which, by the way, was the highest we've ever seen in this indicator going back to the 1980s. It broke trend in March into April and has continued lower. Along this line, this means that the leadership was driving this market is narrowing. There aren't as many stocks behind it. The volume is not as supportive as it was from the late November run up until February, which saw the S&P climb significantly. If this breadth continues to wane, the market will become more susceptible to a reversal, and that 4,100 pivot may be the indicator. In a long story short, We are watching what comes next. As you can see, the breadth model has paused a bit, sitting at about the 56% level. Just to give you a perspective, if you go back way, this indicator tends to average between 45 to 52%, 45 at the lows, 52% at the highs in terms of markets. We are standard deviations above that again. Usually the snapback to the mean can occur in two ways for this chart. A, from the trend line you see up there, up near 58%, or it drops back to that historical range near 50%, which would imply a significant correction for stocks. As this indicator falls lower, this argues that the S's will continue to outperform the N's, value over growth. Our last chart is our primary bull-bear model called the growth model. This model governs many things that we do at Column E, but for today's discussion, we'll show you how it relates to these two indicators. So as you can see, this too has rolled over from its primary trend after rising since November. It came off the March lows, shown in red at minus 0.05. But if you notice, if you go back to the decline we saw in 08-09, you can see the decline was more significant, more broad-based. This one was price action for all of 3 weeks. That is why the slingshot to the upside, coupled with the massive amount of money that hit the system, led to the stock market rally. It follows, if all the money stops coming in relative to stimulus checks or Fed stimulus, stocks will lose energy. A falling bull-bear model like this does not imply necessarily that a bull market is over or a bear market is starting. A return to the 0 to 3 range, though, does look likely, and for that to happen, we would see stocks go sideways for a longer period of time. In our Outlook 2021 note, we expected stocks to perform in line with 2010 returns. If equity risk premiums were to drop more significantly than earnings rise, we saw more of a 2005 setup. The two risks to our outlook are very much in play at the moment, but markets really have not responded yet. We will continue to evaluate and look further into this. Well, thank you very much for watching our first 3 charts in time video version. To learn more about Column E, please go to columne.com. My name is Brendan McCarty, CIO and founder of Column E Advisors. Thank you for watching.